Hello and welcome to another episode of NSE FinWiz Season 6 powered by CNBC TV 18. I'm your host Gautam Srinivasan, and as always we continue our journey towards explaining concepts behind personal finance and wealth creation to the employees of various offices. Our next pit stop is in Gurugram at the offices of India's state-owned electricity utility company, the Power Grid Corporation of India. So let's check them out.
Founded in 1989, Power Grid Corporation of India is an Indian state-owned electric utilities company headquartered in Gurugram, transmitting about 50% of the total power generated in India on its transmission network. Power Grid today has become a company that literally lights up every household in the country. Keeping pace with the changing business environment, the company has set its vision on becoming a global transmission company with dominant leadership in emerging power markets with world-class capabilities. NSE FinWiz, with its theme, Invest in Yourself, Your Path to Prosperity, engaged with the employees of Power Grid in Gurugram to light up their financial path and help them lead a life of prosperity.
Investment in knowledge pays the best interest, as rightly said by Benjamin Franklin. For me, financial literacy is gaining knowledge on how to alter and allocate your resources or investments so as to have a financial upliftment results as well as have a socio-economic impact too.
For me, financial literacy is having a set of skills or knowledge that helps us to make smart decisions regarding our investments, debt credit management. It can be regarding to our savings, or even it can be regarding our increasing our wealth.
Welcome to NSE FinWiz Season 6 powered by CNBC TV 18, where we are all about making your money work harder for you, work smarter for you, and that's where all this topic of discussions come about, where employees of various offices ask questions to financial planning experts which they look to address. We are at the Power Grid offices today, where the employees are all ready to ask a range of questions, and of course we have our two financial planning experts, Gajendra Kothari and Tarun Birani. Gentlemen, thank you so much for joining us. And just like in a cricket match, before we begin, it's always the pitch analysis. So Gajendra, let's start with summarizing the investment climate. Tell us about what's happening in the investment arena these days.
2-3 years back, people started investing in mutual funds thanks to this massive campaign called Mutual Fund Sahi Hai. And if they have gone into SIP mode, be it equities or debt, even that has not delivered, particularly in the last year. So people are kind of, at the crops right now, not knowing where to go. Elections doesn't impact your investments by a wide margin. It can be only bit of up and down, but if you're in for a long haul, it will be a small thing in the entire picture.
All right, and Tarun, the theme of this year's NSE FinWiz is invest in yourself, your path to prosperity. So tell us about the importance of short-term goals versus longer-term goals, because whenever you're planning your investments, you have to balance those things out, and sometimes you wonder where should you prioritize, because if your short-term goals are coming up plus you have got to fund your long-term goals, you kind of wonder how exactly to go about it. So tell us about this short-term goal versus long-term goal perspective when it comes to investments.
We have to define purpose very clearly. You need to be very clear before making any investment, where do you want to go. And we all have different needs. We have short-term need, medium-term needs and long-term needs. Short-term need, I think one of the most important part is contingency planning. You need to make sure anything happens to you, 3 to 6 months of your expenses should always be available in cash. And I feel this is one of the most important goal you need to take care of that. Apart from that, longer-term goals are something, let's say your retirement, your education of your kid, which are 10 to 15 years away. So those are something which has good time available, and the asset class selection could be either of equity or real estate. These are the assets which have delivered the best return. But all assets class have their own challenges. We need to understand these asset class deeply to get the most of it.
Outline the difference between a direct plan and a regular plan for them.
When you invest in mutual funds, you have two options. One is called a direct plan, the other is called a regular plan. In direct plan, it is assumed that you are an informed investor, you are aware of your investment decision, you don't need any help or guidance, and hence you can approach the company or mutual fund directly, either by going to their website or, to their office and buy the fund directly. Now, what happens when you do this? So in mutual funds, every year you incur certain cost. What is that terminology called? Total expense ratio, or TER. Now, how much you pay when you invest in a mutual fund per annum? How many of you have idea? Most of us do not have idea. So if we invest 100 rupees, on an average we pay 2% as expenses every year. Now, what does this mean? So suppose if you invested 100 rupees this year and your investments in 1 year time has become 110, but if there was 2% expenses, then your net returns is 108, right? And every year this 2% will be charged on the value of your assets. So in the 10th year, if 100 has become 500, on the 10th year, 2% will be charged on 500. Now that's a good thing because, as your assets grow, the expenses also increase. Now, when you go in a direct plan, all you pay is the fund manager's fees and other expenses. What you don't pay is the advisor fees because you don't require any advice on which fund to invest. So if the normal regular plan expenses is 2% and the distributor or the advisor earns 1% out of this, when you go in a direct plan, you are only paying 1%. So you're saving on 1% per annum. Now this is a good thing because it saves cost for you, but this is only meant for the people who know what he or she is doing with his or her money.
Right, and Tarun, you had mentioned about the different assets which people need to look at and how each asset is its own beast. It has its own return profile. So in terms of some of the basic do's and don'ts of an ideal portfolio allocation strategy, what are some of the hygiene factors that you would suggest to the audience here? Just some of the basics.
So some of the asset classes available to investors are, as we all know, there is gold, there is real estate, there is equity, right? So as we all know, gold is an asset class which is going to generate a return linked with inflation. So gold has never delivered more than inflation over a long period of time. So as an investor, you need to be aware that it is not a wealth creation asset. It is an asset which can give you inflation linked returns. But coming to a wealth creation asset like a real estate, and in India, we all have a myth that real estate is one of the most royal asset to buy. Real estate हम हमेशा absolute term में देखते हैं. मैंने 10 लाख डाला है वो 1 करोड़ हो गया पर आपने 20 साल भी उसमें लगाए हैं. People don't compare equity. Equity is nothing but ownership, right? So one need to understand this asset class very clearly that over a long period of time, let's say 7 to 10 years, if you have that kind of outlook, then only look at equity. Don't look at equity with a 1 year, 2 year, 3 year, 5 year outlook because I think you will not have a very great experience. We have seen volatility going to kill us.
On that note, we'll take a very short break, but when we return, we'll be discussing more about the topic of this episode, which is retiring rich, looking at investing in long-term equities. Stay tuned. We'll be right back. Welcome back to NSE FinWiz Season 6, powered by CNBC TV 18. Now let's talk about the topic of today's episode, which is retiring rich and, of course, keeping an eye on investing in equities in the long term. So let's get the ball rolling in terms of, how exactly to retire rich. What are some of the do's and don'ts in your opinion?
Now, many of times we've seen most of us, if you see our retirement assets, it's locked in a very safe assets. We are either very pro FDs, fixed deposits, LIC products, gold, or something like real estate, which we think for retirement. Now, these are all safe assets which may give us 6-7% return. What always you have to ask is this the real return? What do I mean when I say real return? Suppose if the FD gives you 7%, you have to pay tax, and if you come in 30% tax bracket, straight away your return comes to 5% post-tax. Then you have to see what is the inflation. Now, in a city like Delhi, the inflation today is around 7%. Post-tax, you are earning 5%, inflation is 7%. How much you are earning net? Minus 2% per annum. And you thought your money was safe. It's actually a guaranteed loss every year, right? That is what many of us are not able to see. So my suggestion is that when you invest in something for a goal like retirement, which is a long way to go, you can afford to take risk. So retirement is like that. You have to take a suitable vehicle like equity fund. If you have time to manage yourself, then you can go in direct stocks. But if you don't have time and expertise, you can go through the equity fund. And the other reason, what the advice I would have when you're planning for retirement, start very early.
All right. And Tarun, weigh in on this whole index fund versus ETF, debate, because passive investing has also gained a lot of traction where people say, you know what, forget the sectors, forget the themes, forget, large multi-caps. I just want to know, if the Indian growth story is going to progress forward and if the market is going to go up, I might as well look at an index fund. So weigh in the benefits and the cons of an index fund versus an ETF. What's your view on that?
So ETF and indexing is basically nothing but a passive way of investing. So if you look at ETF available in India, so Nifty ETF is available at 10 basis point cost, compared to, let's say, a large cap mutual fund where you pay 2 to 2.5% cost. But at the same time, you need to understand US is a highly developed market, highly researched market. India comparatively continues to be an under-researched market. I would say large cap space, if you look at 5 years horizon, ETF makes a lot of sense. One can start looking at ETF. NPS is a very beautiful way to enter into ETFs because most of the NPS money is going into ETFs. So one can look at NPS to start investing at. But looking at mid and multi-cap as well as small cap strategy, I would say active fund continues to be favored.
All right, let's take in some questions from the audience on the topic that we're discussing right now, which is about retiring rich. So the first name I'll call out, Rakesh Kumar, if you could get up.
I have a daughter of 10-year-old. For her study purpose as well as for her marriage purpose, I want some 2 to 3 crore rupees after 10 to 15 years. Seeing the negative return in the last 2 years, should I continue to invest for the long term, 10 to 15 years, where my goal is very clear, and should I change the instrument which I have invested in?
The start may not be good, but if you just hang out there, you will get some year wherein you would have made 40% return in the 1 year. Now coming back to your specific example that you're making a loss in 1 year SIP, I've been doing a SIP for last 3.5 years and I'm in loss too as well. But I'm in fact more happy because imagine all my money is right now going in 30-40% discount. See, right now the market is available at discount of 40% and I'm happy that I'm buying such cheap. One day when the markets go up, I'll be very happy because I would have made a lot of gain, And because your goal is 10-12 years down the line, you don't have to worry today and tomorrow. You have to only wait. You have to only see the actual portfolio when you're coming closer to the goal. That's when you should start moving money from your equity to debt so that, in the last year when the markets go down by 50%, you don't suffer any losses.
Thank you so much for asking a question. Next person I'll be calling out is Romika Chahal.
How do I invest in this volatile market for long-term gains?
First, identify the purpose of your investing. You need to do a suitability requirement for yourself to identify what is your risk tolerance level, what has been your investing experience, your goals are anyway long-term. You can actually start getting into some kind of hybrid or equity investing at this point of time with a long-term horizon. And I think once your purpose is very clear, and you start reviewing on a regular basis, I think your experience is
The purpose would of course be retiring and having a good amount in my kitty.
You need to spend some time, actually write it, and you need to measure it, how much you require. Let's say to live a good life in Delhi, today you require 1 lakh rupees. 1 lakh after 15 years with inflation could be 2 lakh rupees.
Correct.
So what is the corpus you are targeting there? How much savings you have right now? So it's a very detailed exercise. It's not a fun to do exercise, right?
Yeah,
it's a serious money involvement there.
Yeah.
So I would request you to get your financial health checkup done, a financial plan created for yourself.
Yeah.
Start working for it, start reviewing it regularly.
Thank you so much for asking your question. And I guess on that note, we'll take another short break. Retiring rich, that's what we've been discussing in this segment. But when we return, the floor will be open to the employees here at Power Grid to ask any question on financial planning and investments they have to our experts here. And to you, the viewers watching at home, remember you can stay updated with us on our website, nscfinwiz.com, and of course, our social media handles on Facebook and Twitter at nscfinwiz. We'll be right back. Keep watching CNBC TV 18. Welcome back. You're watching NSE FinWiz Season 6, powered by CNBC TV 18. The floor is now open to the audience here to ask any question that they have to our financial planning experts. So let's see a show of hands. The gentleman in the front row, we'll start with you, sir.
This real estate is not returns, good returns. So is it a better advice to put in virtual spaces?
Whether office real estate is a good bet versus residential real estate. Is that
In
your
terms
question?
of risk and returns.
Within even real estate, there are many segments and each one goes through the cycle. So right now, as we see in entire India, residential housing is undergoing a bad phase, and hence many people are thinking commercial real estate may be a good idea. But there will be some point of time in life when commercial real estate also doesn't do well and residential does well, So it's very difficult to time it perfectly, okay? Overall, I say that real estate should not be more than 20-30% of your investments, right? Many people, Gautam, we believe, and since this session is on retiring rich, many people think, real estate is a very good form of asset for retirement. सब लोग सोचते हैं कि अगर मेरे पास 2-3 real estate के properties हों, उनको rent पे लगा दिया, तो retirement अपना set हो गया. That's actually a very big myth, because many times, imagine, you're now 70-year-old and your properties are scattered all over places. To find a good tenant, to do the maintenance, to do all these things, it requires a lot of your time, and and if for 2 months the property is lying vacant, you're not getting the rent, So all these challenges we face, and that's why we say that don't go overboard in real estate, don't lock all your money. 20-30% is good enough. Within real estate, of course, you have to do a lot more study to find out which segment right now at this time may give you better returns in the next 5-7 years, because all these things keeps changing from time to time.
All right, and the gentleman in the pink shirt.
When we are going to buy this mutual fund scheme, but what is the most important parameter, that is alpha and beta. It is not being shown along with the scheme, and that's why the biggest parameter which is missing at the time of buying the scheme. So what is your opinion in this regard, and how you will communicate to the CV that along with the scheme this should be shown also?
I would say in terms of information availability, Indian markets are one of the best regulated markets, and SEBI makes sure that all AMCs are disclosing all the data on a regular basis. So I don't see a problem there. Maybe we can recommend you some more sites where you can visit and all these data will be available to you.
All right, the gentleman in the second row here, then we'll come to you.
The question pertains to the relationship between the large cap, mid cap and the small cap mutual funds and the time horizon and the risk allocated.
There are many companies which are large caps, mid and small caps. The way we see is like, I'll give you to any example of, let's say, animals. Elephant is a large cap. It's a big element. And cat or a cheetah is a kind of a small cap, but it can run much faster. Okay? So a large cap has its own advantages, small cap has its own advantages. Large caps gives you stability. Okay? It may not move much faster. So as per SEBI, the first 100 companies on the stock exchange by market value is large cap. Between 100 to 250 is mid cap. Anything below 250 is small cap. So how do you approach to investing? Very simple. If you are a conservative investor, don't want to take risk, happy with 11-12% return, you can safely go with large cap. You want higher returns, more risk, you want 14 to 15% returns, you can go with mid caps. Anything above 15% returns if you want, you have to go to small caps only, but always remember the volatility will be very sharp. Like 2017, small cap gave 60% positive return, and 2018 they gave minus 40% return. Okay, so the movements will be very wide. You will have to have a very long time tenure to remain invested.
All right, let's take the final question in the segment. The gentleman in the second row, if you could pass on the mic.
Today I have a corpus of 1.5 crores. Today I want to retire. What will be my menu to get a return of 12%?
Now, of course, sir, you have multiple options. Like FD is the simplest option, wherein you can put entire money in FD, but you know that post-tax you'll get only 6%, which may not be sufficient because you want 12% return. Okay? One of the most less talked about investment, again in mutual funds, we have all heard about SIP as a wealth creation tool, but what we don't know is something called SWP, which is Systematic Withdrawal Plan. For the last 20 years, you have been doing SIP to build 5 crore retirement corpus. And now that you have 5 crore today with you, we can start SWP, wherein every first of the month, you can say that I want maybe 10% of my portfolio to be withdrawn. So 10% on 5 crore, or let's say to your example of 1.5 crore is 15 lakh. 15 lakh divided by 12 months is roughly around 1 lakh 40,000, 1.4 lakh. 1.4 lakhs you will get every month on the first of every month, whether markets are up or down. Okay? Now, what will happen? Suppose this year markets has given only 5% return. You have withdrawn 10% from your portfolio. Your portfolio might come into negative, but that should not worry you. Because next year if market gives 15% return, or you have only withdrawn 10%, the remaining 5% is added to your portfolio. So over a long time period, as long as the markets is giving more than 10% return, you will never come down from your original capital.
Thank you so much for asking your question. And I guess on that note, we'll wrap up this episode, a very interesting exchange of ideas on the nuts and bolts of personal finance and wealth creation. And who doesn't want to retire rich? But if you want to retire rich, you have to think smartly about it and action the right plan. I'd like to thank the audience here at Power Grid, the employees here for asking the questions. And of course, thank you to our panelists for giving up such great answers, such great analysis of how they can achieve their goals, and of course the topic that we were discussing on retirement. And thank you to our viewers as well for tuning in. Remember, you can stay updated with us on our website nseffinwiz.com, and of course our social media handles on Facebook and Twitter at NSE FinWiz. Keep watching CNBC TV 18.
It was a great event. The best part was that the event was so interactive and we could have the answers direct from the horse's mouth.
Oh, I think it was wonderful. I got a pretty well idea about how to manage my own savings, how to manage my investments, and basically I think it was more about the long-term investments. So yeah, I think I'm going more equipped to handle my savings in a much better way.
It was a wonderful session for me to make me understand about the long-term investments that I have to make. Currently I have very low risk investments, but to think long term, it's a big commitment for a new generation.